Now, the other type of cost of capital is cost of debt. And how do we find the cost of debt? Every company has to chart out its financing strategy at an early stage. So the cost of capital becomes a critical factor in deciding which financing track to follow, either debt or equity or combination of the two. The early stage companies seldom have sizable assets to pledge as collateral. If a company is starting now, such company will not have enough assets to use as collateral to get debt financing or to secure debt financing. So equity financing becomes the default mode for funding most of the small companies that are just coming up. Less established company as well with limited operating history will pay a higher cost of capital than the older company with solid track record, since lender and investor will demand a higher risk premium forward from the companies. What we are saying is, remember those companies that are just companies that are struggling, no one will be ready to part with their hard-earned currency. I mean, their hard-earned money to them just like that, because they have not known anything about them. That is why if anyone now eventually try to make the money or the finance available, he used to ask for what? For high interest rate, which is the cost to the company. And also investor we also have and we demand for high returns for them to put their money down for company to run. So the cost of debt is merely the interest rate paid by the company on its debt. However, since interest rate expenses is tax deductible, the debt is calculated on an after-tax basis. And how is it done? As I just told you not long, that cost of debt is equal to interest expenses all over total debt into what? Multiply by 1 minus tax. So at times total debt is used for the market value of that debt. Understand? The interest over market value, taking care of the tax. That is a cost of debt. Don't be confused with this. It's just the same thing. And the tax we are referring to here is the company marginal tax rate. The cost of debt can also be estimated adding a credit spread to the risk-free rate and multiplying the result by what? By 1 minus tax. And what is a credit spread? Credit spread is like premium. When you add a premium together with what? With risk-free rate. But risk-free rate and the premium is the excess return you want by taking risk. You understand? So, and that's about the cost of debt. For example, let's give us an example. Let's assume a company paid into or borrow yes, as a debenture of, let's say, 20% debenture of market value of 1 naira. As he purchased the 20% debenture of 1 naira market value. Understand? So, of 1 naira market value. With nominal value of 50 kobo. So So you can see that we have difference between nominal value and oh, yes, let's say is the nominal value is 1 naira and the market value is 90 kobo. He purchased and now illustration. Let's illustrate how we find the cost of debt. Now let's assume we have the market value of debt should be 1 naira and the tax rate is equal to 30%. The marginal tax rate is 30%. The interest is what? Is 20%. 20% interest expenses. That is per stock. That is per debt stock. Now, what is the cost of this debt? So the cost of the debt will be equal to interest expenses. That is 20% of 1 naira. 20% is 0.2 all over market value. That is 1 naira. Let's say 100 kobo. All into 1 minus 0.3. So 0.2 into 1 into 0.7 all over 1. Now use your calculator to do justice to order. 0.2 times 0.7, that is 0.14 all over 1. So the cost of debt is 14%. So that is how it is calculated